So in this video we will discuss about introduction to money and the financial system. Let's start. So every financial transaction has a story, right? So there is a complex web of interdependent institutions and markets making up the foundation of daily financial transactions. The six parts of the financial systems. The five core principles of money and banking. So this is the introduction, right? So let's start with the each part. First one is money. To pay for purchases and store wealth. So money is the base part of any financial system. Then there are financial instruments like to transfer resources from savers to investors and to transfer risk to those best equipped to bear it. So you will hand over your money to the banks or the mutual fund distributors or anyone who can bear the losses in case. Financial markets to buy and sell financial instruments. Financial institutions to prove access to financial markets, collect information and provide services. Regulatory agencies to provide oversight for financial system. Last one is central bank to monitor financial institutions and stabilize the economy. Six parts of the financial system. Let's discuss these six parts in detail now. So first one is money. Money has changed from gold, silver coins to paper currencies to electronic funds now. Cash can be obtained from an ATM anywhere in the world. Bills are paid and transactions are checked online. Second one is financial instruments. Buying and selling individual stocks used to be only for the wealthy. Today we have mutual funds and other stocks available through banks or online. Putting together a portfolio is open to everyone. Third point is financial markets. Financial markets were located in the coffee houses and taverns. Then organized markets were created like the New York Stock Exchange. Now transactions are mostly handled by electronic markets. This has reduced the cost of processing financial transactions. There is a much broader array of financial instruments available online now. Fourth one is financial institutions. Banks began as vaults, developed into institutions to today's financial supermarket, offer a huge assortment of financial products and services. Government regulatory agencies. Government regulatory agencies were introduced by federal government after the Great Depression. Government regulatory agencies provide wide-ranging financial regulation, rules and supervision. Government regulatory agencies examine the systems a bank uses to manage its risk. The 2007 and 9 financial crisis has led governments to consider greater regulation. Central banks. Central banks began as large private banks to finance wars. Central banks control the availability of money and credit to ensure low inflation, high growth and stability of financial system. Today's policymakers strive for transparency in their operations. Five core principles of money and banking. First one is time has value. Risk requires compensation. Information is the basis for decisions. Markets determine prices and allocation resources. Stability improves welfare. Let's start discuss these points one by one. First one is time has value. Time affects the value of financial instruments. Interest is paid to compensate the lenders for the time the borrowers have their money. Chapter 4 develops an understanding of the interest rates and how to use them. Then the next point is risk requires compensation. In a world of uncertainty, individuals will accept risk only if they are compensated. In the financial world, compensation comes in the form of explicit payments. The higher the risk, the bigger the payment, right? Information is the basis for decisions. The more important the decision, the more information we gather. Collection and processing of information is the foundation of the financial system. Markets determine prices and allocate resources. Markets are the core of the economic system. Markets channel resources and minimize the cost of gathering information and making transactions. The better developed the financial markets, the faster the country will grow. Stability improves welfare. A stable economy reduces risk and improves everyone's welfare. Financial instability in the autumn of 2008 triggered the worst global downturn since the Great Depression. A stable economy grows faster than an unstable one. So, very few pieces of information are needed to steal your identity. Protect your personal information. Never tell your date of birth, birthplace, address, and your family name. Guard your social security number and monitor your financial statements closely. So that those are some basics that you can do to protect your identity online or from some financial fraud. So that's it for now.